Now, the first thing that startup investors are really looking for is for you to come to them prepared with all of your ducks in a row or all the necessary documentation that they are going to be looking for. And one of the things that we call that is a data room. If you've ever heard of this phrase before, a data room, what that really is that's just having together all of your necessary documentation, maybe in a cloud format, something like a Google Drive, Box, or any of these other types of ways that you can electronically share a set of documentation with various investors. And so it just makes it easier for you to share that information. When you have it already ready for them, it shows them that you really know what you're doing. Now, there's certain documentation that goes into a data room. So before we get into what these startup investors are looking for, I want to talk to you about what could go into having your data room ready. And this is not an exhaustive list, but it covers quite a bit of it. The first set of things you're going to think about is legal information, such as when you incorporated. So if you formed a C Corp or you formed an LLC, you're going to want to have the documentation that the attorney provided you in that data room. You're also going to want to have your company's bylaws. So this talks about who has the authority to transact business on behalf of the company. So that's the legal information. You're going to want to have your company's current capitalization or cap table. So what this does is details who owns what percentage of the company. You're going to want to have financial documentation in there. This would be things like if you've already been in business for a while and you have expenses and or hopefully revenue, you're going to want to have a profit and loss statement up to the most current date or most current month for investors. You're going to want to have a balance sheet that shows what assets and liabilities the company has and what liabilities the company has taken on. Then you're also going to want a pro forma or a financial projection, whatever phrase you like to use. You're going to want to have a set of projections talking about how you plan to perform in the future. So if a profit and loss statement and a balance sheet looks as of today, profit and loss statement is going to look backwards at how you've performed up till now. A pro forma is going to look forward and it's going to project how you plan to perform financially. You're also going to want to have any documentation around intellectual property that you have. So if you have any copyrights, any trademarks, any pending or issued patents, you're going to want the documents that support that in your data room. And then the last thing you're going to want to think about is having presentation materials. So this would be pitch decks, business plans, those types of things. So I always recommend having this data room ready to go. If you have a website, you could have a link to it for investors to go to and get to that information, whether you want to gate that way it's not public or not, it's your choice. But having a data room or place you can point investors so they can securely get all of this information in one fell swoop really makes a lot of sense. Now, this next section, I'm going to run through each of those sets of documents. I'm going to talk about what startup investors are looking for in those documents so that when they have them, what are the things they look at? And this is the exact types of things when I'm doing startup analysis for the syndicate I'm doing it for. These are the exact types of questions I'm asking as I'm going through each of these startups' data rooms and documentation. So let's go back to the beginning. We'll talk about legal first. So your legal documents, your incorporation papers, your bylaws, those types of things. So those will answer 4 different questions, actually more than that, but these are the key things I look at when I'm looking at this. First of all, I want to know who are the owners. So, who owns the business? Who makes up the board of directors, right? So which people make up the board of directors? That is oftentimes the founders, but sometimes in a startup, oftentimes in a later stage startup, you have people on your board of directors who are not owners of the business. They could just be key advisors. I'm also looking for who has the authority to bind or execute a legal contract on behalf of the company. So if you're a founder and for some reason the bylaws call for maybe all the founders to agree on raising money from an angel investor, then I'm going to want to know that I have to get agreement from all of them on a term sheet that I'm going to offer. And then the last thing to point out when it comes to legal documents is whether or not the company can borrow money. And if so, who has to approve it? That's actually written into the bylaws when you incorporate your company. Reason that's important is, I've just got done doing some due diligence on a company this past week, and they actually have already borrowed money based on some other factors. Even though they're not making a lot of money, they have borrowed money. And so taking a look at that, understanding who has the right to execute that. In this instance, it was one founder who had the authority to execute that that debt on behalf of the company. And if there's multiple founders, as a founder, you don't want it that way. You don't want it where one founder can make a decision for all of you. And an investor really doesn't want that either. So that's your legal documents and some of the things investors are looking for to answer in your data room. The second thing I mentioned to you was a cap table. So again, this talks about your bylaws, your incorporation documents will talk about who owns the company, and it will also talk about the shares that were issued. But generally speaking, that's at formation. A cap table will show you who owns shares in the company and what percentage they own. And so you'll see a listing of founder one, founder two, the shares they own. You may see some advisors with small percentages of ownership that they were given to be an advisor. If you're in an accelerator and that accelerator takes ownership or stake in your company in exchange for being in the accelerator, that would show up on the cap table as well. So when I'm doing due diligence on a startup, asking for funding from the syndicate that I'm working with, when I'm looking at a cap table, these are the three main questions. I ask more, the three main questions that I ask myself. So number one, are there other investors already involved? So if I just pull up a cap table and I see the founders involved, that means there's no other investors that are already involved. If there are other investors listed, I ask myself, are they well-known investors? So if I were to see a startup that Sequoia or Andreessen Horowitz or someone well-known put money into, then that signals a lot more strength than someone who does not have existing investors. So are there other investors, and are they well-known? That can be a really good signal. The next thing I would look for is ownership of the business concentrated, or does the cap table show that just a few individuals have controlling share of the business? So another example, I was doing some due diligence on a company this week, and in it, the two founding family members controlled 78% of all of the shares of the company. Then some advisors had small percentages, and then there were two different investors involved. Why does that matter? Here you can go back and reference in the legal documents. Remember, we talked about the legal documents, the bylaws, who can make decisions on behalf of the company. If on the cap table it shows that there are one or two or three certain number of individuals that can have controlling interest in the company, and the bylaws say it takes controlling interest to approve a decision, then that could mean a single founder or two founders or however many there are with that controlling interest can transact business on behalf of the company. And then the other thing I look for on the cap table is, I mentioned to this earlier, what percentage of equity each owner has. Now, I'm going to point to this in a different way. This isn't about controlling interest. This is actually about pointing toward valuations. So here's what I mean. If there are other investors on the cap table and they own a certain percentage, then I can use that to sort of think about what the valuation was that was given at the time of that investment. So if that investor gave the company $100,000 and they own 10%, depending on if it's pre-money or post-money, we'll talk about that another time, that helps me understand what the valuation was at the time that investor got into the deal. And that helps subsequent or follow-on investors think about the valuation of the company. Okay, let's jump to financials. I talked about profit and loss statements, balance sheets, and pro formas. So here, the reason this is important is with profit and loss statements, I want to know, is the company profitable? So first of all, I'm looking for, are they generating revenue in the first place? They may not be. Maybe they just have a bunch of expenses, some R&D because they haven't even built their prototype yet. If they have revenue, are they profitable? Is the revenue more than the expenses they are taking on? I also will think about, what is the company's burn rate? So burn rate is just the monthly spend that the company has. When I'm looking at the expenses, if I see $60,000 a year, that means to me their monthly burn rate is $5,000. Why does this matter? When we look at what amount the company is asking for, that turns into what we would call a run rate, right? So with a burn rate, if they're burning $5,000 a month, that's $60,000 a year they're burning, and they're going to raise $100,000. That's right at 1.5 years of capital that they would have on hand. So I use that information to think about burn rate and profitability. I look at the expenses. Where are they spending money? Does more of it go into research and development, or are they past the research and development stage and they're pouring it into marketing to take on customers? I also wonder, is by looking at the expenses, is the company frugal? Is the founder running it frugally, or are they, buying it, expensive first class plane tickets every time they travel somewhere? Are they, decking out the office if they have an office? Are they decking it out with just the coolest trinkets just to be cool and try and be the next, fun startup? Or are they being frugal with the investors' money? When I look at a balance sheet, I just look at the basics of it. What assets does the company have? What things does the company have that are worth money? I look at what their liabilities are. Again, back to the borrowing piece. Have they borrowed money before? And then lastly, a balance sheet will help you understand how much equity has been built up for the shareholders. Since with a balance sheet, it has to balance. When we look at equity, we should see, is the company worth something, and is it growing, or is it sort of losing equity? And then when I get to pro forma or projections, I think about how the company's anticipating performing in the future and what the assumptions were that were made to build those projections. Are they realistic assumptions? So, for example, this is a really important note because of pro forma or projections is where I'm seeing all kinds of startups fail and perform poorly during due diligence. If you are projecting, let me just give you some example numbers that I'm gonna mix them up a little bit, but I'm gonna give you a rough idea of what I've just seen recently from one startup. They were saying that they were gonna make a couple $100,000 in profit the first year. Then they were saying they were gonna make $435 million in profit in year 3. Why is that important? They're saying they're gonna go from a couple $100,000 in profit to hundreds of millions of dollars in profit in just 3 years. Folks, that's completely unrealistic for just about every company out there. So performa is where people are really falling down. If you do not think you have the skill set to build a proper set of performa or projections, please hire that someone to do that for you. This is a place where everyone is messing up. Okay, another place, intellectual property. In your data room, I mentioned having a folder that's got all your IP. So this would be patents, trademarks, copyrights. What I'm looking for is, does the company have patentable solutions? This creates a moat of defensibility to protect the products and services that you're offering. It makes it harder for new entrants to compete against the startup. If there are patents in there, are they pending, or has the patent office issued them? Issued is what you really want to see. Are there trademarks in place? Have they trademarked their name? Have they trademarked a particular phrase that is important for the branding of their business? If there's software, do they have copyrights in place that are going to protect that software and the code that software was written on, even if there aren't patents? And then the last set of things in a data room is the presentation documents. So the pitch deck and sometimes a business plan, depending on the investor that you're meeting with. So this is important because it covers just about everything else that was not already in the data room. So if you build a pitch deck appropriately, you're going to talk about information about the leadership team. So maybe beyond just the founders, now I know their experience, because that should be included on a pitch deck or business plan. I find out through these documents how much money the company's looking to raise and what type of facility or structure they're using. So are they using a safe? Are they using some other type of funding structure? I find all this out. I also find out, and this is the next big tip for you to think about, how they plan to go to market. So I mentioned to you that founders are messing up on their projections pretty consistently when I do due diligence on them. The second place they're messing up is on their go-to-market strategies. Marketing is the biggest thing for you to focus on, particularly if you have a product that is ready to go to market. I'm seeing founders make all kinds of mistakes by not focusing their budget on marketing and not focusing building a team that has professionals who can handle marketing. Of the 2 startups that I reviewed in the last week for this syndicate, both of them were messing up as it comes to marketing. They were asking for dollars for marketing, but they had no one on the team that could run marketing for them. I don't want to see you make that mistake. Other things a business plan or pitch deck help you think about is, who are the main competitors? Are they entrenched in the market? Do they have a better solution than yours? Investors are also looking for how the company established its pricing structure. So how did you decide you were going to price your product? How does it compare to the competitors? What distribution channels you're going to use? We're curious as investors, how do you plan to get your product in people's hands? And then also, if there are any strategic partnerships in place. So It's a lot of information to digest. I hope you'll watch this a couple of times and take notes. Those are the types of things that an angel investor is looking for, and us, candidly, venture capitalists as well. But those are things that the angel investor syndicates that I'm part of or doing due diligence for are looking for in a startup. If you can check the boxes on these things, you have a really good chance of attracting an investor to your startup. Until next time, hope you have a great day.